low-key, keep it softly spoken.
The second part of technical analysis, right? We'll be delving into indicators, right? Now, what are indicators? Basically, just as the name implies, they indicate, they tell you buy, sell, buy, sell. But it's not just as straightforward, right? These indicators, they come in such a way that sometimes you have to combine them with price action or combine them with each other to get something accurate or something useful, basically, right? Now, you can basically categorize these indicators into four major groups, right? Four major groups. It's not exhaustive. You can have different sources that'll tell you that there are more different kinds of indicators and stuff, but these are like the four major groups of indicators you have, right? You have trend indicators. Trend indicators basically show you the direction of the market, the direction of price. They show you where the market is going. Is this an uptrend? Is this a downtrend? That's what trend indicators tell you, right? So some examples, this is by no means exhaustive. There are plenty and plenty and plenty of indicators. There are several indicators, and there are a lot of trend indicators, several of them. So you have moving averages, you have MACD, you have Parabolic Sar. Momentum indicators just basically shows you where the momentum is swinging, like where the force of the market appears to be swinging, right? This is something that reversal traders use a lot, right? Reversal traders use a lot. You have stochastic, RSI, CCI. Volume indicators tell you how much activity is going in that direction. Okay, let's say fine. If trend indicators tell you the direction of the market, right? The market is going up. How much activity is actually happening? How much buying power is in the market? Are the buyers active? How much are the sellers in control of the market? Are the buyers in control of the market? This is what volume indicators will tell you. And examples, you have OBV, unbalanced volume, OCI, you have checking money flow. Then volatility indicators. Volatility just basically talks about um, um, the extent or the how far price moves in a given period, right? How far price moves in a given period, right? So in forex, like we already know, we deal in pips, right? We deal with pips, right? So with volatility indicators will tell you by how many pips on the average price has moved in a given period, right? How many pips on the average price has moved. So it will tell you which currency pair is moving a lot, which currency pair is moving mad, or which currency pair is too sluggish, is not even moving at all. That is what volatility indicators will tell you. So examples, you have average true range, you have Bollinger Bands, basically. Now let's go to the chart and talk about these indicators, right? So, we're back to our charts, right? So we're back to our charts. Let's clear it up. Let's clear it devoid of any indicator. Now, for a beginner trader, the first indicator you would want to be familiar with is your moving average, right? Moving average, like it's a trend indicator, of course. The moving average is a trend indicator, right? And it's the most basic trend indicator you can think of. It points you in the direction of the market, basically. Points you in the direction of the market. And what is a moving average, basically? It just basically it tells you the direction of the market. How does it determine that? It just calculates the it's mathematical, basically, so we won't go in depth into that, but it calculates the average movement of price over a given period of time, then it plots that out, right? It plots it out as a line, right? A moving line, a line that moves with price. So it plots out that average movement as a line that moves with price. What am I talking about, right? So let's okay, let's stay with this 4-hour chart. Let's put a moving average on this chart, right? Let's put a moving average. So I'll put a moving average on this chart. A blue, you can see that blue line, the blue wavy line. You can see it, right? You can see the blue wavy line I put. Now there are different kinds of moving average, right? There are different kinds of moving average. There's the simple moving average. What I've put here is the simple moving average, right? There's the exponential moving average. There's all moving average. There are so many different kinds of moving average, but what you will be of interest to you for now will be simple moving average and maybe the exponential moving average, right? Now, the difference between them, basically, the simple moving average, the difference between the simple and exponential moving average is that with your exponential moving average gives um it gives more importance, like it gives more weight to prices that are closer to the price of the time you are considering. Now, don't get confused. Let me break that down. Let me tell you what I mean by that. So let's say that let's zoom to what the market is at currently, right? Let me delete all these trend lines. Delete all those trend lines, right? Delete all those trend lines. Okay, so now this is where the market is at currently. This is the last candle for this time period. This is the last 4-hour candle, right? So this is where the market is at right now. So now what your exponential moving average does is it gives more weight to more recent prices. Like, so it gives more weight to more recent candles, right? As opposed to your simple moving average that gives equal weight to all the candles of the period you are measuring, right? So simple moving average gives equal weight. Exponential moving average gives more weight to more recent prices. You get, so it makes sense that the exponential moving average will react to price faster than the simple moving average will, because it's giving more weight to um, it's giving more weight to more recent prices, basically, right? Giving more weight to more recent prices. So now, let me show us this. So let me take this away. Let me make this okay. Let me take this away first. So let's start with this. Let's start with this simple moving average. Let's start with this simple moving average. You see how wavy it is, right? Now, what you want to understand is you can adjust the period of your simple moving average, right? You can adjust the period of your simple moving average. What that basically means is you can adjust how many candles you want it to take the average of. It should take the average of how many candles. Do you get? So now, as it is now, what I have it on is 9. Length is 9. So what this means basically is that this moving average is calculating the average movement in price for the past 9 candles, right? For the past 9 candles. I can adjust it and make it 14. Now let's make it 20, right? 20, and you will notice a change in the waviness of that line. You will notice a change now. See, there has been a change in the waviness, right? So it has adjusted the period of average it is calculating. So it is taking the average for the last 20 candles now, basically. So unlike before that it was 9. When it was 9 candles. Now it's 20, right? So you can adjust your moving average to suit whatever taste you want, right? Can adjust your moving average to suit whatever taste you want. But There are several ways to use moving averages in Forex, right? There are several ways to use moving averages in Forex. Now, moving averages can be used to determine trends, right? Moving averages can be used to determine trends. Moving averages can be used to give an entry signal for you to buy or you to sell, to determine whether you're going to buy or you're going to sell, right? And you do that by using moving average crossovers. I'm going to talk about all of that now. Now, basically, even though you can adjust the settings to anything you like, right? Basically, there are still some common moving averages that are used in Forex, right? There are some common moving averages. The most common ones, right? The most common moving averages you might want to know will be 20 that we've already put here. Let me change this 20 moving average. Let me change the color. Let me change the color to red. Let me change the color to red. No, I like this one. Yeah. Let me change the color to red. Thickness. This. Okay. Yeah. Okay. Yeah. So you want to know the 20 moving average. The 20 moving average is very common, right? The 20 moving average. You want to know the 50 moving average. Let me add the 50 moving average to this. 50 moving average, right? Come here, change it. This this platform I'm using to do all of this chatting, I'll still explain something about it. Trading view, I'll still go over it, right? So I come here, I change this to 50 blue style, keep it blue. The thickness, I want it to be this thick. Okay, yeah. Now you also want to know the 200 moving average, right? The 200 moving average. Let me add the 200 moving average here. The 200 moving average, yeah. So I'll adjust the settings here. 200. I change the color to let me change the color to green. Thickness, yep. So that is fine by me. Yes. So as you can see, we have three moving averages here. The red is the 20 moving average, right? The blue is the 50 moving average. Yeah. The green is the 200 moving average, right? Now, there are different ways to use this to your advantage, right? There are different ways to use this to your advantage. Now, the 20 moving average being the smallest, right? It reacts to price the fastest because it's closely following price, being that it's calculating the average movement of price for the last 20 candles, right? So it's closely following price. Compared to 50. 50 reacts slower than 20, right? Because the average of 50 will be smoother than what you have for 20. 20 will follow too fast because it's just be going because it's 20 is smaller, right? But 50 is a little smoother than 20, right? It's a little smoother than 20. Now, compare both of them to 200. 200 is almost a straight line because, I mean, before you approach 200, it's going to take something. It's going to take a while. So it's way smoother than both of them. So now, how do you use them? How do you use these moving averages, right? We said that moving averages are trend indicators, right? They are trend indicators. Now, let me first talk about how they show you the direction of the market, how they show you trend, right? So let me show you, let's start with the 200 moving average. Basically, there's a there's a like a hard and fast rule you get. It's like a hard and fast rule for when you want to use moving average, 200 moving average, right? When price, when the candles are below your 200 moving average, right? You are in a downtrend, right? When the candle is below your 200 moving average, you are in a downtrend, right? When the candles are above your 200 moving average, you are in an uptrend, right? That is like the mantra, right? So when candles are below your 200 moving average, you are in a downtrend. When the candles are above your 200 moving average, you are in an uptrend, right? Now, how does that help you? How does that information help you, right? Now, let's say, for example, here now, um, let me come here. So now, look at it now. Price came here, came above the 200 moving average. So here, price is above the 200 moving average. But here, price is below the 200 moving average. So here, you can say that we're in a downtrend. Here, you can say that we're in an uptrend, right? So here, it's a downtrend. Here, it's an uptrend, right? Now, how can you use this to your advantage? How can you use it to your advantage? I will just teach you a simple beginner strategy to use moving averages now. I will teach you a simple beginner strategy. I will teach you the common one that is commonly taught to most people. Then I'll teach you the best, like the better way to do it, like the best way to actually do it. The best way to actually do it, right? The best way to actually do it. So now look at this. Let's focus on this area, right? Now we know that price has gone above the 200 moving average. The green is the 200 moving average, remember. Price has gone above the 200 moving average. Now, if you want to determine, okay, what is even happening? Now, first we can establish that this market is in an uptrend, right? Why? You are correct if you said because price is above the 200 moving average. So, the market is in an uptrend, right? Now, how do you want to maximize this market? Now, when you know the trend of the market, right? When you know the trend of the market, you want to use moving average crossovers, right? To determine where the market is going, to determine when to buy or when to sell. Now that you are in an uptrend, usually what do we say? The trend is your friend. The trend is your friend. When you are in an uptrend, always look for buy opportunities. Always look only to buy. When you are in a downtrend, always look only to sell. When you are in an uptrend, always look only to buy. When you are in a downtrend, always look only to sell. Now, price is here now, right? It's above the 200 moving average. So price is in an uptrend. So you are looking for what? Sell or buy? You are definitely correct if you said buy. You are definitely correct if you said buy. So now I'm looking now moving average crossovers. What does moving average crossover means? It just basically means one moving average crossing above or below the other one. Usually the smaller moving average crossing above or below the other one. So now you are in an uptrend, right? When the 20 moving average crosses the 50 moving average, crosses downward over the 50 moving average, normally you are supposed to sell, right? When the 50 moving average crosses upwards above the when the 20 moving average crosses upward above the 50 moving average, you are supposed to buy, right? So now that we are in an uptrend, what opportunities are we looking for? Buy or sell? We are looking for buys, right? So That means that we are looking for periods that this crossover will give us buy signal, right? We are looking for times when this crossover will give us a buy signal, right? We are looking for buy signals. So that means we are looking for when the 20 moving average will cross over and above the 50 moving average. When the 20 moving average will cross over and above the 50 moving average. So when you look at this now, when you look at this, there's a cross here, right? So when this cross happens, imagine you bought, right? Imagine you bought. Now, depending on where you set your take profit, or where that take profit means where you decide to get out of the market, you could have made some profit, right? Because you bought here. Let me use this cross right. Use this cross here. You bought here. You bought right here, right? At look at just look at your right. Look at the black icon on your right. Look at the price it is showing. 1.90759, right? 1.90759. Now, depending on when you decide to get out of the market, right? Look at price went up, 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 up. It got as far as here. So it got as far as 1.91523, right? 1.91523. So depending on where you decide to get out of the market, you could have made some money, right? You could have made some money up to here because the price went up to this point. You could have made some money actually, depending on when you decided to get out of the market. So because at that point, it now started going back down and it went way down. So if you did not get out of the market on time, you would have ended up losing, right? Now, let's look at another cross. Let's look for another cross. Now, mind you, it crossed down here. It crossed down here, right? Look at this. The 20 moving average crossed down below the 50 moving average right here, right? But are we in an uptrend or a downtrend? We are in an uptrend. So we're only looking for buys. So normally we should not place a sell here. We're not supposed to sell here. So we leave that trade. We look for another buy opportunity. And that buy opportunity is what? Is when the 20 moving average crosses above the 50 moving average again, which happened here, right? So at this point, you can actually buy. So if you buy here, if you place a buy here, that means price kept going up, 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 up in your direction, goes up, 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 you will have made some money, right? You will have made some money. Depending on when you decide to get out of the market, you can even make more, and even make more, and even make more, because price got up to this point, right? Price got up to this point, right? Now, and so on and so forth, right? So we look for another point where 20 moving average crossed over 50 moving average, right? It crossed here again. When it crossed here, if you buy at the close of this candle, if you buy, you would have made some money again, right? So this gives you a chance to predict where price is going and place your buy and sell appropriately. That is one way to do it. That moving average crossover I just described, the 20 crossing over the 50, that is one way to do it, right? That is one way to do it. Let me show you another way. Right? Which is probably the better way, where you don't need the 20 to cross over the 50. So let me take the 50. Let me take the 50 away from this chart, right? Now, all you just need, right, is your candle to cross, is the candle now, right, that you are looking to cross the 20 moving average, which is this red, right? You are looking for your candle to cross the 20 moving average, right? You're looking for your candle to cross the 20 moving average. So price is still above the 200 moving average. So we are looking for buy opportunities, right? So we are looking for when the candle will cross above the 20 moving average. So look at this point, right? What happened here? The candle crossed above the 20 moving average. So if you buy here, what is going to happen? You are going to make a ton, like a large amount of money. Like you're going to make a lot of money, a lot of pips. Let me not say money now. You're going to make a lot of pips because depending on how much you put, you're going to make a lot of pips, right? Yeah. So price got there and went back down. So look at it again. Price crossed again up. If you place a buy here, if you buy, you will make some profit. You'll have made some profits, right? Price started going back down and crossed here again. If you buy here, you will have made some profits. Price went back down, but it didn't necessarily cross down. But let's say you assumed it crossed down and you had bought here, right? You would have still made some profit because price kept going up, kept going up, kept going up, kept going up, kept going up before it came back down. Now look here again. Price crossed up again, and if you had bought here, it kept going up, it kept going up. So you see, this is probably even a better way to do that crossover. So you determine which one you want to use, but these are the best ways to actually apply your moving average. Moving averages can be very powerful, right? Moving average can be very powerful and can be very useful tools. Can be very useful tools, right? Now, moving average is the commonest trend indicator, right? But it is not the only trend indicator, right? It is not the only trend indicator. There are quite a number of trend indicators. Right? For example, let me show you the MACD. Okay. Let me close this 50. Let me show you the MACD. So the MACD, it just means moving average convergence divergence. Now, what does the MACD do? Moving average convergence divergence. So basically, you can see some things like bars here, red bars, blue, red bars, green bars, red bars, green bars, right? You can see them. All right, so this is the MACD, right? Moving average convergence divergence. So how does it work basically? So you can see these you can see some lines, blue line, orange line. You can see green bars, red bars, green bars, red bars. The green bars are above, red bars below. So how does it work, right? It is this is an indicator that is one of a group of indicators that is called a zero line cross indicator. It's a zero line cross indicator, right? So how does it work? Now when price when price is when price is above the zero line, right? When price crosses when price moves above the zero line, you are in an uptrend basically. When price moves below the zero line, this is the zero line here. Let me show it well so you see. Right? So this is the zero line right here where this dotted my dotted thing is, right? So that is the zero line. So when price moves above that line, when the two lines, the blue and orange line, when they move above that line, you are in an uptrend. When they move below that line, you are in a downtrend, right? That's how the MACD basically works, right? That's how the MACD works. Now, when you are now in an uptrend, you are now looking for buy opportunities. When you are in a downtrend, you are looking for sell opportunities. So when you are in an uptrend, right? When you are in an uptrend, that is when the two lines are above the zero line. What you are looking for is a cross. You are looking for an upward cross of the blue line over the orange line. So you are expecting, so in this territory now, you are expecting the blue line to cross upward over the orange line, right? And that will tell you to buy, right? That will tell you to buy. In this territory down here, you are looking for the blue line crossing down over the orange line, which will tell you to sell, right? So That is how the MACD works. That is how the MACD works. So let's just show an example here of it in action, of the MACD in action, right? So here, in this small place here, right, you can see that the 200 moving average is showing you that you are in a downtrend here because price is below it, right? Now you now look here. At this point, the MACD now comes to this territory below the zero line, right? The MACD now comes below the zero line, right? So you are looking for a sell opportunity here. That's what you are looking for. You are looking for a sell opportunity. But you will notice that the blue line is still, it hasn't given you a signal because it hasn't crossed down below the orange line. But look at this point here. Let me show you this point here. So look at this point here, right? Yeah, at this point here, it now crossed. You can see a cross down here, right? You can see a cross. So it crossed here where the hand icon is. It crossed here. So if you had sold at that point, look at it, right? Look at this candle. Look at the candle at that point. If you had sold, if you had put a sell at that point, look at it. Price kept going down. You will have made quite a number of pips in that direction. You will have made quite a number of pips, right? You will have made quite a number of pips. Now, look at this point, right? Look at this place here. Price is above the 200 moving average. So you are in an uptrend, right? You are in an uptrend, right? So look at your MACD. You wait for it to get to buy territory. So you are waiting for it to go above the zero line. Now it has gone above the zero line. It went above the zero line around this point, right? So you are waiting for a cross above the orange line. So it comes. So you see this, a cross happens here above the orange line, So you see at this point, you see this candle, you buy. If you had bought here, price will have kept going up, and you will have made quite a number of pips. So that is how to use the MACD. Let me just show you one more trend indicator. There are so many of them. It's just up to you to check and see the one that fits your style. Right? Let me show you another trend indicator. I'll show you another trend indicator in a jiffy, right? So let me show you the parabolic SAR. Let me show you the parabolic SAR. So the parabolic SAR, right? Parabolic SAR just means parabolic stop and reverse. Parabolic stop and reverse. So let's search for it among the indicators here, right? PSAR, parabolic stop and reverse. So let's open it here. Yeah. No, I don't like this one. I don't really like this one. No, this is not the one I want to show. This is not the one. No, this is not the one I'm looking for. Parabolic SAR, PSAR is not the one I'm looking for. PSAR. Let me see this one. Exactly. Yep. So this is the parabolic SAR, right? So, how you use the parabolic SAR? You can see all these dots, right? You can see all these dots. Now, you can see green dots, you can see red dots, green dots, red dots everywhere, right? Now, what these dots are telling you to do, right? So now, at this point now, right, we're in an uptrend because price is above the 200 moving average. So we're looking for buy opportunities. Now, buy opportunity for parabolic SAR, right? What represents a buy opportunity for parabolic SAR is when you have the dots coming below the candles, right? So as soon as you have the dots come below the candle, you have a signal to buy for the parabolic SAR, right? You have a signal to buy for the parabolic SAR. So let's see some points where we got some signals here, right? So we're looking for buy signals. So we're looking for the first dot below our candles. So for example here now, all these dots were above our candles, right? We're over our candles. So we're looking for the dots. So let's say at this dot here, let's say we had bought, right? So we would have made profit. Look how it's going. It's going up, right? We'll have made quite a number of pips there, right? Now, let's look for another opportunity. Okay, this one is another dot, but we couldn't really have made any profit there. Would have made a small loss, in fact, right? So this, we wouldn't really have taken this trade because price was below the 200 moving average. So we'll wait for price to go back above the 200 moving average. Then we'll wait for another signal. So another signal is right here, this dot here, right? So we would have bought here and price went up, right? We'll have made some pips, we'll have made some profit, right? Another signal is right here. We would have made quite a lot of profits here, right? I made quite a lot of profit. So yeah, is it like the dots came under, but we are below the 200 moving average. We wait for price to go back over the 200 moving average. The next signal is here, right? So we buy here, we would have made some profit. We would have made some profits right here. So that's the Parabolic Sar. So there are quite a number of trend indicators, Ichimoku cloud, and a host of other ones, right? And a host of other ones. So that's trend indicators, right? So I've just shown you the basic ones that you can use and create a simple strategy out of. I've shown you some simple strategies here that you can just use to trade and make some profits, right? So I'll just be showing you some other kinds of indicators. Momentum indicators just basically show you the strength of the trend, right?